is Avijit Chatterjee recording our weekly session for the week of April 7th, recording this on Sunday, April 13th evening. The market, of course, has been extremely unpredictable. There's been a lot of volatility, and in particular, last week, we got many people calling for a Black Monday. The previous weekend, there wasn't an expected kind of a deal with China, or for that matter, on the tariff front. So people had gone a little anxious over the weekend, and Jim Cramer was out there on a Sunday evening show calling for a Black Monday, which, that Black Monday term comes from the October 1987 crash when the market tanked way more than 20%. Well, we did not crash as much as many thought, many of the Wall Street pundits thought. We did come down almost a 5% lower move, and then likely we hit a capitulation with respect to massive volume on the downside. So yes, there was tremendous volatility the entire week. VIX touched over 50, and we kind of bottomed out, we feel, over the week of movements. We look at the hour-by-hour move in the market. This weekend has also been extremely volatile. Yesterday, which is on the April 12th, there was news on the technology, whether it's the semiconductors, the laptops, the computers, being not subject to the high tariffs that were announced on China. So there was an exception ruled out for them, at least for the several weeks ahead, and they would come out with a separate tariff on semiconductors. So that caused, as we know, market is closed over the weekend, but Bitcoin trades 24/7. So look at the Bitcoin chart and see how did the market react to that news. It did shoot up. And then Howard Lutnick came out and said certain things that the market didn't like. And then again, we lost up some of those gains. Then President Trump was in the news this afternoon, and that kind of, again, is getting some upward movement in the market. So we look at the big picture. We look at some of the experts, the technicians, such as what Helene Meisler is saying. Her mentor, Justin Mamis, a very well-respected technician, he had long time in the past drawn out a sentiment chart, a sentiment cycle chart. We look at what that chart looks like with respect to the current market conditions as Helene Meisler has drawn it. And we will also look at Mark Newton. He is the Fundstrat chief technical advisor to Tom Lee and the Fundstrat, the company out there. We look at what he was on CNBC last Friday. We'll see what he was saying. So this is our website, our blog site. It's at substack.com, chartsarefun.substack.com. See the archive link here. We post daily blogs. If you subscribe to it, it's free. Share your email. You get the blogs in your email. It usually comes out about 7 a.m. every day. Then our YouTube site is also Charts Are Fun. We do believe a lot of fun insights in the charts. We are not financial advisors. So our goal here is not to give you financial advice, but to share some fun patterns in the charts. And hopefully you find them interesting. If you do, please do subscribe to our channel, and also hit the like button if you like our videos. Something very fundamental happened last week. We've been hearing in the news that on Wednesday, which is on April 9th, there was a Trump put in place. And the statement was that President Trump focuses more on the bond market than on the stock market. And in particular, that week, which is last week, Treasury Yield shot up. In particular, the 10-year Treasury Yield is what he and our Treasury Secretary Scott Bessent focuses on. That shot up. As we know, when the Trump tariffs were announced on Liberation Day, April 2nd, we look at it, 10-year yields actually went down. It went down towards 3.8%. From there, it shot up a lot, crossed the critical level of 4.5. So we'll see, as a result of the Treasury market, President Trump went out and put a 90-day pause. The 90-day pause then caused the market to find a bottom, to find a footing, and rally back higher. Now, what's the underlying reason for President Trump and his administration to be concerned about Treasury yields? So if you Google and you just say 2025 US debt refinance, we know that the US is in debt. We know that there's over 35 trillion in debt for the nation as a country. We do need to refinance. Not everything matures at the same time. This year in 2025, you can see that almost 9.2 trillion in debt is maturing, which means you got to have the debt refinanced, which means the yields now, if they're so much higher, it's going to cost the US a lot more to pay the interest on that debt, and hence the interest to see if he can get the debt refinanced at a lower rate, which means get that 10-year yield lower, because a lot of these debt is higher long-term treasuries yields, and to refinance them, you got to get the yields lower. Now, they don't come down with interest rates. As much as Chair Powell and the FOMC may do whatever they do with interest rates, it's not going to help the yields come down. The yields come down with economic outlook, with the way the world trades around treasuries, and the way the world rates US from its credit limit, from its credit rating, and how it overall is an outlook as a country. So that's key. So 9.2 trillion in debt maturing this year in 2025. And add to that an additional, we have deficit spending. The US does not have a budget surplus. We have a deficit spending. Add another $1.5 to 2 trillion on top of that. So you're talking about 11 to 12 trillion of debt that's going to have to be refinanced this year. And it's key that the long-term treasury yields are hence kind of tailored lower. Now, one key factor that you look at, this is the hourly chart of 10-year treasury. It's called the TNX. In stock charts, you map it by dollar TNX. This is where we can see that on April 2nd, right? April 2nd was, of course, the Liberation Day. End of market that day is when the Liberation Day tariffs were announced, hefty tariffs across the world. You can see that treasury yields actually dropped into April 3rd when the market opened, which means market safe haven buying in the treasury happened, which is a typical characteristic. Treasuries are supposed to be safe haven buying. So stocks were selling off, treasuries were being bought. And from that 4.22 level, it fell down towards the 3.88 level, right? That's how much it fell. And since that April 4th, when Chair Powell came in, he wasn't that dovish. He was concerned, extremely concerned about inflationary impact from these tariffs, and said a lot of uncertainties out there. He wasn't in any move to do an emergency cut, as in the past, the Federal Reserve has done. So that, and then with the outright trade war that China declared against President Trump. That's the day on April 4th when they said that they're going to reciprocate back with whatever tariff that Trump puts in. And they've been doing that. The Trump tariff is China with 34% plus the 20% earlier tariff at 54. Progressively went up as high as 125, and they've kind of been keeping up and matching those tariffs with their retaliatory attempts. So that trade war started off officially on April 4th. Yields have shot up. Many say that China has been holding a lot of US treasuries. They hold almost 800 billion or almost a trillion of US treasuries. They've been selling treasuries actively, and that could be the steep climb in treasuries. But technicians, when they look at this chart, this is the hourly chart, you join the peaks and join the bottoms. This is what you call as the rising wedge, and this is a bearish pattern. Bearish pattern in the sense of price in the price levels. This means that this climb is unsustainable. It comes back down. This followed with the negative divergence in RSI when it climbed to a higher high towards 4.59 or 4.6% on Friday, the April 11th. We can see a lower high in RSI. So that's a topping pattern, which means we feel that going into this week, this upcoming week, the week of April 14th, we expect yields to come down, and that could be calming to the markets. Market at this point is extremely anxious to see 10-year yields shoot up, and this is also why on that particular day, on April 9th, when it shot up, you can see this is one of the fastest climb in yields from 4.16 to 4.47 at the heels of crossing the critical 4.5 level is when Trump acted in the first couple of hours of trading on April 9th. And he acted in the sense of he announced the 90-day pause, and then the yields from there fell down. From going into the next a couple of days after that, it further shot up till towards the late part on Fridays when yield started falling down, closing around 4.49, right at the 4.45 level. So this yield climb then led to the semiconductor technology news Saturday, which was yesterday. Trump's administration saying they're going to have an exception to semiconductors, the chips that go into smartphones, into various technology devices, into laptops and so on. And those tariffs, so those will be announced later. That hopefully is going to help bring yields down. We'll see how the market reacts. But we see a very nice, in this particular case, a bearish rising wedge, which means we see 10-year yields come down. Now, another key factor that you have to look at is the steepening of the yield curve. The yield curve, in this case, measured by the 10-year yield, subtracting it, the 2-year yield from the 10-year yield. So US 10-year, dollar US 10Y minus dollar US 2Y. So 2-year subtracted from the 10-year. That, when it steepens, is often an indicator of a recession ahead. In the month of December into January, we see that it climbed from a negative. So we, as you know, we had an inverted yield curve last year. Most of summer of last year, we shot up down to as much as minus 0.65 of inversion, as in the 2-year was higher than the 10-year at almost minus 0.65. Since then, it has been climbing, steeping to up to 0.54. It didn't quite, this is a you're looking at this particular chart as a daily chart, but you can notice that it didn't quite close at 0.54. It closed a lot lower, but it had steepened. Then it fell towards the month of February into March, and now recently, during the tariff situation, 10-year has been climbing, 10 years, and by this 2-year, that steepening happened quite a bit, where it actually retested that 0.54 near 0.58 and closed above 0.55, literally, on this first part of April. So that is not a good sign. Economists are worried about this indicating recession. And if you look at long-term history, I've shared this in a blog, this usually yields in some form of a recessionary signal. And this has happened in the 2007 financial crisis. Yield curve steepened even during the COVID times. Anyway, there's financial distress, the yield curve starts steepening, and that often leads to a market pulling back, which we know we've already gotten a pullback in the market recently. Now, the long-term chart of Treasury, and this is what we are focusing on, the 10-year yield, potentially could be some form of topping pattern, as in we see that we reached almost to the 5% in 2023 bottom in October 2023. From there, we pull back towards the 3.6%, which is right around September of 2024. Then Powell came in, as he started cutting rates, it didn't really matter. Market started getting nervous about a Trump win. Market started getting nervous about inflation coming from his policies. It has since then shot up to 4.8. We didn't quite get to 4.8 in this move up in last week. This is a weekly chart, but we've kind of came close towards the 4.59, 4.6%. That said, if this is kind of a bit of a topping pattern from a 3.6 to a 5, that's 1.4. Subtract 1.4 from 3.6, you're looking at closer towards the 2.2 level. So 2.2%, if that's where the 10-year yield is headed, that could indicate some serious recession. Typically, when recessions happen, you do start getting 10-year yields fall. And this could actually be huge for TLT buyers. There's a lot of them who are kind of buying into TLT, expecting kind of a slowdown in the US economy, expecting slowdown in the world economy, and TLT is safe haven buying. So if a 10-year yield can break below 3.6 and come back towards 2.2, you can expect TLT to break out above a key level at 100 and go towards 120, 121. So this opportunistically for TLT buyers might be a good time to buy TLT, accumulate TLT, which is right now around 85 to 86 for a breakout above 100 towards 120. That's a possibility. Now, what would the bears be looking at? The bears on the bonds, the bond market bears would effectively be saying, you know what, this could from a 3.6 to a 4.8 is a 1.2 at the 1.2. So they would be looking at this as a breakout of a 4.8. So 1.2 from 4.8 adds it to 6%. They would expect, there are folks like Guy Adami in Fast Money. He has been for quite some time expecting a breakout above 5% in 10-year yield. Now, that's just world shunning U.S. Assets, U.S. Treasuries as much as stocks, and 10-year yield going haywire. And even Ray Dalio has been extremely bearish on the U.S., losing its dollar reserve status as the reserve currency of the world, U.S. losing its status as the safe haven buying for foreign investors. And so that's what the bears are looking at, the 3.6 to 4.8, 1.2 add to the 4.8. So we'll see. This is right now a tug of war going on between bears and bulls. Bears won last week on the treasuries, shooting up the yield towards 4.6. But if we are correct on this bearish rising wedge, which means yields come down, and if we are correct on this topping pattern, then we think treasuries goes towards 2.2 long-term 10-year yield treasuries, which means TLT has a massive rally. So we are actually on the bullish side of bonds. We feel that bonds have a very good rally coming up, and this could, as soon as over the next several months, we have better clarity on what goes on with the tariffs. And also, of course, this in many ways could also trigger from the fact that we do get a slowdown in the US economy that could cause this to come down. But we shall see. At this point, there is also an effort from how US manages its debt, right? We have a huge amount of debt. If there is some positive news on the debt management front and so on, maybe US's credit rating looks better. Maybe investors are willing to pay lower yield on the treasuries, and that could help the yields suppress. And it could be bonds and stocks rallying together. That's the part we have to see. Now, we talked about this weekend has been extremely volatile. And if you kind of look at Walter Bloomberg, he tweets about all these Trump administration statements and so on. You can see that on April 12th, which is on Saturday, yesterday, US published tariff exclusions for specific products, which are computer smartphones. And that's what caused the Bitcoin, which is right here, to rally. This Bitcoin rally that we see, this is on April 12th. This is Greenwich Mean Time. So around 1 was around 9 a.m. That's when the news came out, between 9 to 10 a.m. And you can see that Bitcoin broke out above key level at 84K, went up to 86K. And then over Sunday, which is today, as we are recording this on a Sunday evening, it did come down. And in particular, we saw something around um, 2 p.m. Greenwich time, which is around 10 a.m. or so. Right around between 9 and 10 a.m. is when Howard Lutnick came out. He had a bearish statement to make about, we're not quite saying that the tariffs on semiconductors would be waived. They would be an exception list, but we are going to be acting strongly on the semiconductors. Market sold off, gave up all these gains back to the 83K again. And then from there, it started recovering. Market still wants to rally. We feel that the near-term bottom has been put in place. Market wants to rally higher. And we said that from the 10-year yield, that's what the key. Bond markets won't trade over the weekend. When bond markets open on market tomorrow, we shall see how it trades. But we do believe that there's a possibility that yields start coming lower. And then this part came in. President Trump was out there. There was again some very bearish pullback to the 83K. And right now it's kind of retesting that 83K twice. And we'll see what happens overnight. We'll see if this market can get a bid and shoot back towards the 85 to 86K that we saw yesterday night. But right now, market is volatile, as we know. And this is Helene Meisler, a very respected technician, writes on Real Money. This is called the Streets, the Real Money Pro. I subscribe to it. It's a subscription. Here she's drawn a sentiment chart by her mentor, Justin Mamis. And here she's saying that we've had that collapse into the panic level. Our panic point was April 7th on last Monday. From there, we had a V-shaped recovery. She feels that right now, according to Justin Mamis, this panic then had some bit of a snapback rally, and then the discouragement phase comes over, and the discouragement phase to Helene Meisler has not yet happened. So she feels that we post-hire, we kind of sideways trade for a few days, and then we have another pullback to retest the lows, and then from there we start having a recovery maybe later into the summer timeframe. And Justin Mamis, though this is not supposed to be an exact chart of any kind, it's kind of a zigzag pattern, but giving you an indicator about the cycles of sentiments. This is where enthusiasm, which is what we know we had in the February peak, There were people in late December, economists, analysts talking about a 7,000 S&P 500. The bullish of the most, Ed Yardeni had a 7,000 target on S&P. By the way, Ed Yardeni's forecast now has come down after this panic level. Even he's panicked. He's now projecting a 6,000 S&P target for 2025. He, however, is long-term bullish. He feels, if you listen to him, there's a nice recording of his interview recently. He feels that U.S. is in a secular bull market, is going to come back and is going to retest, go back towards 7,000 by 2026, 27. But at least for 25, from the tariff-related uncertainties and shakeouts, he believes that his new target is 6,000. So, but that said, Helene Meisler's panic up to Justin Mammis's pattern up where this is level, this horizontal line here, when it's going to retest, she believes is anywhere in 5,500 to 5,700. That's what she's looking at. And then the pullback, retest to the bottom, and then from there, a move higher. And that's what she's saying. And it turned out Mark Newton, who's the chief technical strategist for Fundstrat, he was there and on CNBC on Friday, and he called it for 1 or 2 months of sideways pattern, which is similar to what Helene Meisler is looking at, right? This sideways pattern. And he calls it an L shape. So L as in this is the drop in the L, and then the L forms with the sideways pattern before we start seeing a move higher. So he also agrees with Helene. He's not looking for a V-shaped move. He's considering it an L shape. So what are our thoughts? First of all, we would like to look at what the hourly chart of S&P 500 is telling us. We can see a beautiful cup and handle form here. We can see here that we got a sharp pullback into April 7th. This is that 5% drop from Friday into Monday. This is where Jim Cramer was out there talking about a Black Monday, a 20% plus drop. Didn't get that 20%. Market recovered from a 48.35. We'll show you why that number is very critical. This happens to be exactly at 78.6% of that 61.47 peak. That's a beautiful Fibonacci number. 78.6% of 61.47 is 48.35. That's what we got. And from here, we try to make a rally back on the 90-day pause news on April 9th, up to 54.61. Got a pullback onto that Thursday by late afternoon. Then from there rallied back. But if this is a cup and handle, 48.35 to 54.81, that measures kind of a move back up towards the peak, 61.27. Not far from the 61.45 high that we saw. If that turns out to be a cup and handle, we got to see. But that right now is what we're seeing from the hourly chart. Now, if you look at the percent of S&P 500 stocks below the 200-day moving average, that had a beautiful bottom, touching 15%, which is very rare. So it touched 15% of the S&P 500 stocks were basically above the 200-day. That is, 85% were below the 200-day moving average. That was extreme fear, extreme washed out, or extreme panic. So that's what happened on April 7th. We retested that on April 9th before President Trump did the 90-day pause. So 15.4, 16 got tested twice, beautiful W-shaped bottom. And from there, we went up to 32 immediately after the 90-day pause on tariffs were announced. We got a pullback, a shallower pullback towards 22. We expect this to break out 32 and move higher. Now, you wouldn't say that this follows technical patterns, but this double bottom test of that 15 extreme pullback. And if you look at a long-term chart of it so that you get an idea on how low do these numbers go, well, we can see that back in 2008, the financial collapse, it had dumped to single digits of only 1% of stocks were above the 200-day moving average, is a 99%. That's a significant secular bear market bottom. That's when that goes as low as that. 2011, we also touched a very, very sharp pullback. And then from there, we've noticed that in the 2020 COVID drop, that was also a sharp pullback. Only 3% of the stocks were above the 200-day moving average. This was a significant waterfall decline in sentiment with very washed out levels. We never, and then we got a huge rally with liquidity pumped into 2021, where that was a big sign of a market top, and S&P 500 had 97% of the stocks above the 200-day moving average. The flip side of the bearishness. This was extreme bullishness. From there, 97 fell to 10.6 in the October bottom of 2022. The October 2024, we were at a higher low at 23, and now we just this is a monthly chart. Over the month, we have touched 15, but we are already back above the 15. And I expect this to close for the month of April much higher than the level we are now. So that's the percent of stocks above the 200-day moving average. Let's look at some breadth indicators. This one is the Nasdaq's McClellan Summation Index. This is the average, like not the average, but it's the cumulative number of advancers minus decliners in the Nasdaq Stock Exchange. And here we can see in the 2022 bottom, it had hit minus 1180, slightly higher low at minus 1085, and now even a higher low closer towards the minus 1000. We believe that, look at the RSI at deeply oversold levels at the last 3 times. We believe this is also indicating that the market has hit its bottom. Very similar to October of 23 and October 22, which means we expect next week for this to start printing higher values, for it to start climbing back higher. And we'll see. I know right now the market, we look from Bitcoin perspective, is retesting that low at 83,000. But overnight, if you're watching and you have subscription to stock charts, I have a pro subscription, can watch minute by minute, but this I expect to start turning higher. Look at Bitcoin overnight and see if it starts claiming the 85,000 and starts making an upper move. It's a leading indicator that means the market could have a decent upside into tomorrow and further down the week. Also, like the Nasdaq Summation Index, there's a New York Stock Exchange. So there are 2 exchanges, the Nasdaq and the New York Stock Exchange. This is for all the Nasdaq stocks, which we know is technology heavy. The New York Stock Exchange is a lot more diversified. And that also has been printing higher lows. Minus 1138 was the low in October 22, minus 834. And very recently, we are above somewhere around the minus 590 towards minus 600. So higher lows here, indicating that the market breadth isn't as bad as it was in the bearish 2022 October and 2023 October bottoms. But this is nearing a level of bottoming as well. We expect this to start climbing. And as this starts climbing back towards the 1100 level is where we expect the market to be a lot higher from now. Taking a big picture view, it's very important to see how has the current bear market played out compared to what we saw in COVID? And that was also under President Trump's first term. Very, very similar patterns. This was February 19th, by the way. That 3393 peak was February 19th of 2020. Guess what was the peak on the 2025 bear market? 6147, also on February 19th. Call it an eerie coincidence, but February 19 turned to be the peak here, turned to be peak here. We got a 35.4% pullback. That, of course, the world was coming to an end, kind of a view with COVID shutdowns across the world. 23 days, sharp pullback, 35%. Recently, 21.4% pullback in 33 days, 10 more days. But look at the candle here. Look at this candle here. These are called reversal candles. When you leave a long tail in the bottom, those are likely not to be tested again. And from there, we had a sharp V-shaped move. Are we going to get a V-shaped move, or are we going to have a flattish kind of consolidation and L shape as Mark Newton has been saying it, or as Helene Meisler shared in our sentiment chart? That's the part none of us know. If we knew, we would all be millionaires. But we feel that looking at the market, looking at possibilities of any kind of deal that is made on the tariff front, and anticipation of now the tax cuts to be extended, and anticipation of fiscal policies that are conducive to growth for the U.S. economy could perhaps lead to some form of a V-shaped recovery. The key part there, of course, is going to be the 10-year yields. They need to come down. If the 10-year yields break 3.6 and come back build towards the lower 3, small caps will rally. There's going to be a much broader market rally, and you can expect housing sector to benefit tremendously, because think about 10-year yields directly. Take that 10-year yield, that 2% is what the mortgage rates are. It's going to help bring the mortgage rates lower. It's going to help the housing sector. And so we shall see. But we think that if you look at the bigger picture, that's the secular bear market we're in. This is climbing steady higher highs, higher lows. It's been testing this rising 50-month moving average in blue. It keep testing it every few years in a cyclical way. Back 2022, we did that. From 48.18, we pulled back to test the 50-month moving average. We touched the 61.47. We almost came close to testing it. The level was 46.62. We didn't quite get there. We rallied from slightly higher, from above the peak of 2022 at 48.18, we did 48.35. So we believe that this was a successful test. In a secular bull market, you get cyclical bear markets. This was a cyclical bear market like in 2022. And then in 2020 was a cyclical bear market, but much sharper from the rising channel, from the top end of the channel to the bottom end of the channel. Here, we believe it's just going to be testing the midpoint near that rising 50-month moving average and go back towards the top trend line. Where do we see that level come out to be? Let's look at Elliott wave analysis. 2191 was the low of COVID, March 2020. From there, we had a solid wave one climb. That's the primary wave one climb to 4818. We had a pullback from there to wave two bottom right here, somewhere around the 3490 level. Wave three. So, there are three primary waves of climbs, bullish climbs, and two corrective waves. So the two corrective waves are this one, wave two, and wave four. So wave four, we can see is from 61.47 to the 48.35. That's about the kind of the drop that we just got, the 21% drop that we just got. From here, we expect this climb. If typically when you have a Elliott wave move and wave three is the longest wave, you can see that this wave from 2491 to 61.47 is a much longer wave than this climb here from 2191 to 4818. So if that's the wave that we are looking at, this measures closer towards the 74.62, that wave five top. If this matches, if this length, wave five matches that of wave one. We shall see if it gets there, but we are expecting new highs to be definitely coming in the next several months into maybe 2025, into 2026, crossing the 6147 and climbing towards the 7,000, 7,400 level is where we think S&P could be headed. So this is, in summary, not the time to panic. We believe that we did have a panic low already. This is, as we can see, with the S&P 500's stocks below their 200-day moving average. We can see that, and then recovering from it. That's how lows form. 15% was how the stocks came down to. Of the 15% of the stocks above the 200 days, and 85% were below the 200-day moving average. So that was a panic low. We believe that the Treasury yields kind of are in a topping pattern. We feel they will eventually break below 3.6, and that would indicate, better long-term borrowing for investors. Housing sector should improve. Small caps are very reliant on raising financing for their growth, and that could help small caps as well. And we believe that on the summation indexes, they are also hitting their higher low from the previous lows in 22 and 23. So this was another cyclical bear market. We believe the higher lows in the summation indexes likely indicating that a bottom is in place, and we should from here, and also mapping the 2020 bearish move to the 2025 bearish move, both in two precedent terms. Precedent term, second term was the first term, 33 days was the 23 days, 35% was 21.4%. And we believe that the secular bull market is going to resume, and we're going to climb to higher highs in the next few years. Good luck investing. We'll talk to you next week. Thank you.